Sarah Bloom Raskin is a former Federal Reserve Governor and former Deputy Treasury Secretary, and she's with us tonight live. Ms. Raskin, welcome. It's great to have you with us, and good to see you in my hometown of Washington, D.C. How does this rate cut help the average person or the average business in America in light of what's going on?
Well, Tyler, it really doesn't do much for the average American or for the average business owner. It really was, I would say, mostly a symbolic kind of action. Monetary policy really isn't the right tool for the problem here that is emerging and evolving, which, of course, is this potential pandemic. Yeah, I mean, we have really already quite accommodative conditions. So while this was a surprise move and a dramatic move, it was one that was done outside the usual scheduled meeting format. I would say it really isn't going to do much for the average person.
A 50-point cut in the middle inner meeting is usually the kind of thing, it's kind of shock and awe. And there wasn't much shock today, and there sure wasn't much awe. As you point out, and as Jay Powell pointed out, it's not going to make anybody feel better who is ill. It's not going to get more test kits into the market anytime soon. What moves would have helped more, in your view, or could help more?
Right. I think it's really time to pivot to some targeted fiscal and structural responses to what is emerging here. And you've pointed out, Tyler, the need for kits, right? I mean, we need to get kits out into the hands of practitioners so that people can get tested. People want to know whether or not they can go to work. We need, by the way, paid sick leave, right? There is actually a correlation between whether countries have paid sick leave and the spread of illness. So, in our country, only 40% of people, I would say 40% of people do not have paid sick leave. Well, that's kind of significant because if people aren't going to be paid,
right.
I'll tell you, they're going to have to go to work. They're going to want to go to work, and of course, when you combine that with a disease that's highly contagious, that is going to really keep our economy from bouncing back.
Let me turn you to two things in conclusion. One is, what is the 10-year Treasury signaling to you, and how much ammunition does the Fed have left if something more goes wrong with interest rates where they are?
Right. Two great questions, Tyler. So, first of all, there is, as there always is, we see this repeatedly, a flight to safety, right? The dollar is a safe haven currency. So even though we are experiencing an uptick here in the path of this potential pandemic, we are seeing a strong dollar. We are seeing a flight here of a safe haven kind of nature. So that really doesn't surprise me, and I think we should plan on that continuing. In terms of your second question regarding what else the Fed can do, what other ammunition is left, you're pointing to a really important factor here, which is that the Fed is already very close to the zero lower bound. In other words, the Fed funds rate is quite close to zero. And of course, what we need to know is what happens when we get to zero. What will be left in terms of potential ammunition? And we know from the financial crisis that there had to be a whole other set of tools that had to be called on, because during the reaction to the financial crisis, the Fed had to do massive amounts of accommodation and bring the Fed funds rate down to very close to zero.